Hi, this is JD Henning. Welcome to the V&M Breakouts forecast for week 38. It is September 17th, and I put together 6 slides to give us a good overview of what to expect next week and in the month ahead. And we will start with looking at the S&P 500 SPY ETF, and this is the July chart showing the events with quantitative easing from 2009 leading up to the end of quantitative easing number 4 in March of 2022. The Fed has since begun quantitative tightening in June, and we're still seeing this trend in the negative channel from November with high fluctuations, high volatility, but bearish stair steps continuing. Now, I expect the lower bound of the positive channel to be tested, as I've been saying all year. Some analysts think it could go much lower to 3,000 on the S&P 500, like an overshoot as occurred back during the COVID correction. We shall see, but there's still more downside likely ahead. That's the big picture. And this is the S&P 500 on the weekly chart, and you can see here quantitative easing began in March of 2020 and marked the bottom of the negative correction, and it was fairly stable positive channel all the way up, and then as quantitative easing ended and the Fed began taking out liquidity, we have seen an increase in volatility, and very consistent to what we saw in 2018. These are bearish stair steps that I think will continue lower. They tested or came close to 380 this week, and we may see a retest of June lows around 364 or 3,640 on the S&P 500. We've had 3 major negative signals, and we're into another negative signal on this indicator on the weekly chart. And then this insert here is of the Fed balance sheet, and I've been tracking the weekly additions and reductions of their balance sheet for the year, and you can see how they ramped up through January and ended in March, leveled off to June, and then we've been in a sharp decline since June. What we're not seeing yet is a sharp decline for September, which was supposed to be at twice the rate. It was supposed to double the rate of decline from June to $95 billion in reduction for the month. In fact, it's gone up in the past week. That may mean steeper drops are coming, so we could have higher volatility and more declines in the weeks ahead. Again, something to be cautious of. This is a look at the federal funds rate, and this is what they're doing with interest rates again this week. We expect that the Fed is going to hike another 75 basis points from the current level up to 3%, which would put us on par with the highest Fed funds rate since 2008, looks like. And what's unique about this is it's the first time that we've gone over this trend line. This is the same trend line shown here with a red dotted line, and we're currently at 2.375, which is level with the 2018 level. But every time the Fed has hiked to lower highs along this trend line, it's led to a recession, and they've had to cut rates, as you see, to lower lows each time. Now, in the last reduction after the COVID correction, they went down to basically zero and have come up at the fastest rate of increase over here that we've seen in over 20 years, which could have a significant impact on the market, especially as we're moving above this trend line for the first time since the 1980s. And we will see how the market reacts to that in the coming weeks. So again, something else to be cautious about as the Fed announces new rate hikes this week. This is a look at the utility 3X utility fund, and the reason I'm showing that is that it's a remarkable validator of the broader market price movement. And I've overlaid it with the negative momentum gauge signals for 2022, and you can see how it correlates very closely with all these topping signals. We're coming off the highest level since April, with a negative signal in August and a negative signal in September. Further, it broke the positive channel from June, and it's likely headed to a 40 support test and potentially even back down again to the prior levels in February and in June. That could indicate that the markets are going lower, and has been a reliable validator of that. What I have here is my new sector gauges for the utility sector. I'm rolling out gauges for all the different sectors, and I'm tracking them with different funds for, you can see here on the chart. But what's interesting is it just turned negative this week and has been positive since over a month, 38 days. And we're getting our first negative signal, and we could see this negative gauge level rise to prior levels that were extremely high back in the April or in the May, June timeframe. So something to watch for, another warning indicator, and other gauges are showing similar negative forecasts. This is the Apple chart from the last video that I did in August, and I was showing how it was rolling over, breaking the positive channel, mid-channel, towards a retest of support, but it was coming down from the highest overbought levels since December of last year. So this was a very negative topping indicator, and sure enough, we ended up with a negative signal in August, and as I'll show you, the Apple chart currently rolled over in August and has moved further negative through September. You can see we had a remarkable bear bounce in the channel. I think this one day was over 4% up, and then it gave it all back the next day. We're still testing support at 150 level, and I think with these indicators negative and more indicators turning negative, we could see more lows, potentially even another test of the June lows, but not without some more volatility and more buy the dippers getting in there to add to the volatility in this negative channel. I think at a minimum we'll see support tested around 143 and then potentially 130. Over here we have the other major mega caps, Google and Microsoft, on a weekly chart, and they are both testing key support levels, not only to June and the lows of 2022, but back to the prior year support levels. Now this, if this breaks, it could unwind very sharply with this Google price jump back in 2021 to lower support levels. The indicators are still negative, and there's a very strong chance of further downside. Microsoft also is testing the June lows, and other mega caps like Meta have already broken down to the lowest levels since March of 2020. So they are already down to these levels. Google, Microsoft, Apple, and others are still holding up relatively well, but we're in a major downturn. Lastly, I want to show you the weekly and monthly momentum gauge signals. You'll see here that we've gone 9 months negative from November. August gave us our first positive month, and September has already turned negative as a warning signal in the first few weeks. We have here the weekly momentum gauges. We're negative 3 weeks into September, with declining momentum gauges from August for earlier warning signals. So these are more confirming indicators that we could see more downturn through the end of September and potentially into October. Again, we have a lot of uncertainty with the Fed hiking rates to the highest levels we've seen since 2008. And we have more quantitative tightening coming. So it's probably a good time to move more to cash or add to some bear funds in the short term. And I hope this presentation benefits you, and I wish you all the best.